All right, welcome to chapter 5. In this chapter, we are going to be covering merchandising operations. So, merchandising operations are going to be a little bit different. Here, we're going to move on from, and we've covered prior, was sales for servicing things and doing service operations. Now, merchandising, we're actually going to talk about merchandising, what exactly it is. But basically, we're going to be talking about how people resell things, either to business to business, B2B. We're going to be selling supplies or other parts to other companies, or as a wholesaler, or we sell directly to the consumer. So, this is where how we do accounting for those things. This is how we account for all the how businesses account in the merchandising industry. So let's talk about the different sections we're going to be completing here. Section one, we're going to describe merchandising operations and the two types of merchandising inventory systems because now we're dealing with inventory, we're dealing with merchandise. Okay, so how do we inventory this? And there's two different ways that we do that in merchandising. 5.2, account for the purchase of merchandise inventory using a perpetual inventory system, which is the first inventory system we're going to be talking about. Account for sales of merchandise inventory using a perpetual inventory system. And then we're adjust and close the accounts of a merchandising business. And so first thing we're going to do is talk about the perpetual. We're going to talk about how to purchase, how to sell, and then we're going to talk about how to close that account for perpetual. Then we're going to prepare merchandiser's financial statements, use the gross profit percentage to evaluate business performance, and then we account for purchases and sales of merchandise inventory using the periodic inventory system. So the main nuts and bolts and of this whole lecture is going to be talking about the perpetual system, and we're going to talk about what that is and how we account for that. After we finish discussing that and discussing the whole system of perpetual, then we're going to talk about periodic, which is a little bit easier to discuss and a little bit easier to analyze. And so that's why we talk about it afterwards. We're going to account for sales of merchandise inventory using the net method. And that's going to be the last thing we account for in Appendix 5B. So, our two appendixes are going to be talking mostly about periodic systems, how to close and do things in that system. The main lecture is going to be discussing the perpetual system. So, we're going to describe merchandising operation in two types of merchandise inventory systems. A merchandiser is a business that sells merchandise or goods to a customer. The merchandise that type of business sells is called merchandise inventory. So anything that you create, merchandisers don't actually, I apologize, merchandisers don't actually create the product most of the time. They're either reselling it as a wholesaler, right? A wholesaler buys goods from manufacturer and sells them to retailers. So you're doing business to business sales, or you're a retailer and buys merchandise from manufacturers, or a wholesaler and sells a good to consumers. So this is retail. This is where we get retail stores, right? So if you go to the store, you're buying it, the merchandiser is selling the product directly to you, and as you're the consumer, right? Or they can sell it directly to the wholesaler who then can sell it to a retailer, right? So there can be three steps, or they can be a direct to the retailer itself. But all of these count for merchandising operations. So the operating cycle in merchandising, it begins with the company purchases inventory from an individual or business called a vendor, right? So usually they'll get it from the direct source, right? And they purchase that from a vendor, which they could either do from a manufacturer or they could do this from another merchandiser, right? That directly sells to them. The company then sells the inventory to a customer. Finally, the company collects the cash from the consumers. So customers. And so this can be any of your mom and pop shops. This could be a big retailer, right? This could be something like Walmart. This could be something like Amazon. They're purchasing the product from somebody else and selling it directly to you, even though, or people on their site, they purchase the product. A lot of wholesalers do this. They purchase the product from a company that manufactures it in China, and then they bring in an inventory here in the United States and sell it directly to you and have it shipped to you. So here's the operating cycle, right? So first, we have cash, you purchase inventory with that cash, and inventory you collect, cash goes out, you sell the inventory, accounts receivable, or you can receive cash. Doesn't mean that you always sell on credit, but a lot of customers or a lot of merchandisers do sell on credit. A lot of retailers don't, right? Or they do create their own credit accounts or they don't. But We collect cash from the customers. Either we get a cash, a lot of business to business, you'll get accounts receivable. A lot of direct to consumers or customers, you'll get directly cash from the customers. So you collect cash from the customer and then you use that cash again in your inventory. So the income statement merchandiser reports sales revenue rather than revenue, right? So you're in a merchandising business, you no longer perform service, you're selling goods. So you have the service revenue, we now have sales revenue when we look at the income statement. The cost of merchandising, the customers called cost of goods sold. So this is a new line that we'll have in our income statement. We'll have cost of goods sold. So instead of having sales and then we start having all of our expenses, or we have our revenues, then we have our expenses, we'll first have sales, then we'll have the cost of goods sold. Then that will give us our gross profit, which is net sales revenue minus cost of goods sold. So gross profit is what we receive after we take out what we paid for the product, right? Cost of goods sold. And then we can start deducting our operating expenses, right? Which will give us our net profit. Operating expenses, which are expenses other than cost of goods sold. So you have direct cost of goods sold, right? These are things that for the exact product that you purchased. And then everything that's added onto that, your salaries, your office people, HR, advertising, any of that stuff is operating expense. And we'll get more into it as we go. So this is what the financial statements of a service company and merchandising company. This is comparable. So here we have sales revenues for service company, we have net sales revenues for merchandising company, right? And so we have service revenue and we have sales revenue. We have operating expenses. We go straight to operating expenses with the service company. With a merchandising company, we first deduct cost of goods sold. That gives us our net profit. What actually we collected over what we paid for that product. If we paid $3 for that product, we sold it for 10, we would get a gross profit of $7 per product. So here we're showing what we paid, what we received, what we paid for the goods, and then what was our profit on the sales. Then we have our operating expenses, salary expense, rent expense, depreciation expense, utilities expense. And then we have our total operating expenses. Then we have net income. So when it comes to merchandising, we add one extra step, which is the cost of goods sold. That we don't have in service revenue because we didn't purchase anything. We just performed a service. Now, our balance sheet, we're going to have current assets, accounts receivable. So we'll have cash, accounts receivable, same merchandising inventory. So this is going to be a new line on our balance sheet. And we have a new asset, which is our inventory, right? The things that we purchased. An asset is anything that we're going to use to create more revenue in the future. Merchandise and inventory, that is what we receive revenues on. So that is an asset. And just having supplies and prepaid rent, prepaid assets, we have to include merchandise and inventory. So this is the new thing that we're going to be adding to our balance sheet. This is our new asset. So businesses need to determine the value of the merchandise inventory on hand and the value sold. The two inventory accounting systems. So we have to determine how much do we have on hand, how much is sold. So there's two ways we can do this. We can do a periodic inventory system, requires a physical count of inventory to determine inventory on hand. So we can have everybody go out and this is usually not a daily thing. When we do a periodic inventory system, we usually do it on a monthly, quarterly, or yearly basis. We go out and we count, we base what we show in our books, right, is what we purchased. And then we go and we see how much we actually have on hand. And then we deduct the difference, and that tells us what we have in our inventory because we physically count everything that we have. A lot of companies now and most corporations have a perpetual inventory system. This keeps a running computerized record of merchandise in inventory, right? So this is when you go in and you're checking out, and now most places are self checkout. And as you're scanning your items, not only is that telling the computer what you're purchasing and adds up your total, it's actually deducting it from the inventory. It's saying, hey, we sold another one of these items, we sold another one of these items. And so this way, you're keeping a running system. As you're purchasing items, the inventory is updating every purchase. Every time that an item is purchased, every time that barcode is scanned, now the system knows, hey, we sold another 5 t shirts. We sold another 3 bananas. Every time that you have that system updating, it's updating the inventory and keeping a running balance. Now, that we will talk about that, but perpetual inventory system, we keep that ahead, but we still do periodic perpetuals, you'll still have to do a physical count in the end. Go ahead and continue with chapter 5 or section 5.2. Now we're going to account for the purchase of merchandise and inventory using a perpetual inventory system. Now remember, a perpetual inventory system is a system that is automatically updating as you're making purchases or as customers are making purchases or as you're making sales. So let's see how we account for the purchase of the merchandise. Now, the cycle of the merchandiser begins with the purchase of merchant inventory. Of course, we need to have something to sell or to merchandise to sell to our customers, so we have to purchase it first. An invoice is the seller's request for payment from the purchaser, right? So usually when you're doing business to business sales, you'll make a purchase or you'll make an order and you'll receive an invoices, right? And this is invoices are also called bills. So you receive a bill, hey, you've 5,000 iPads or you requested 10,000 shirts, right? Let's just put this in an easy example. Hey, I want to start my own shirt company. I think I have some cool designs. I'm going to get on Alibaba. I'm going to request some designs. I think this is cool. I'm going to have a shirt made a certain way, and I'm going to order 5,000 shirts. Or say I'm going to start small. I'm going to order 500 shirts from Alibaba, and I'm going to have the manufacturer send them to me. So I ordered the shirts. I get a bill. Sellers have sales invoices, so I get that invoice, and I get that bill and purchasers have purchase invoices, right? When I sell it, let's say I'm a wholesaler and I like to sell it to other retail stores. If I purchase, say I'm purchasing, I can have a purchase invoice and then the seller can have a seller's invoice. So if I purchase it and then I sell it to another retailer, they put it on their shelves, then we'll have two separate invoices. So let's see. This is a purchaser's invoice, right? Southwest Electronics. In this example, you were purchasing touchscreen tablet computers, right? And so we're going to say we are the purchaser, right? And we are purchasing from number one shows who we're purchasing from Southwest Electronics Direct. And when they are shipping to us, Smart Touch Learning, and this is the same company we had in the prior example, but now we're not doing teaching, now we're selling iPads. So instead of being a service industry where we're doing services and giving seminars and teaching things, we're now going to be ordering or selling merchandise, which is going to be the iPads or the touchscreen tablets that have the information already on them that show the customer how to do things. They're shipped to us, right? So one is the explanation to sellers, Southwest Electronics, number one. Two, the purchasers, Smart Touch Learning. That's who we are. We're purchasing it. Three, the invoice date is needed to determine whether the purchaser gets a discount for the prompt payment. See number four. So this is the invoice date. This is the day that they issued the bill. And so four tells us what kind of time limit we have for our discount. So 3% within 15 days, 315 net 30 days. So if we make the payment within 15 days, we get a 3% discount. We pay the full amount within 30 days. So you have to pay the full amount within 30 days, no discount. And then four, or that's what we have number four. Five, total invoice amount is 35,000. So it tells us this is our 35,000 dollars our total. And six, Smart Touch Learning's payment date. How much did Smart Touch Learning pay? So they paid on the 15th, which is within the 15-day period, and due date, so we can see that on the 6th they paid. And to just double check within the 15 days, 7 tells us, if we look at number 7, it tells us payment occurred 14 days after the invoice date within the discount period. So Smart Touch Learning paid $33,950, 35,000 at a 3% discount. How do we know the due dates? They even do the due dates and due amounts. So if we pay by the 16th, here on number 7, you can see that we'll only owe 33,950. Got to pay by that date to receive the 3% discount. If you pay by the 1st of July, then you pay the full amount, the 35,000. And so you can see they paid on the 15th, which is a day earlier. They paid within 14 days. And so they received the 33,000, the 3% discount. Smart Touch Learning receives the goods from Exhibit 5.3 on June 3rd and makes a payment on that date. So, Touch Learning, we as we're doing a perpetual system, we receive the merchandise. So that goes into an account called merchandise inventory. That is an asset. It goes up by debit. And we paid out cash, 35,000. That is an asset that goes down credit, right? Says the merchandise inventory account as an asset used only for goods purchased that the business owns and intends to resell to customers. Office supplies, equipment, and other assets are recorded in their own account. So this is our inventory asset. We don't inventory anything else, and nothing else goes into this account unless it's something that we plan to sell as merchandise, right? Something that we're purchasing just to resell. If it's something we're going to keep, then it's something we need to make another account for. Now, assume that on June 3rd, instead of paying cash, Smart Touch Learning receives a merchandise inventory on account. Then this journal entry is going to change. You're still going to have merchandise inventory be debited because we still did receive the $35,000 worth of merchandise, right? Now, we'll talk about the discount later when we pay and everything, but we have accounts payable Southwest Electronics Direct, 35,000. So now we have an accounts payable instead of cash. Purchase inventory on account. Notice that we have added the name of the vendor after the account payable. This helps Smart Touch Learning keep track of the various companies it owes money to. So this way we don't if we have many different bills and we have different due dates, we know how much we owe each company by putting their name after the account payable. So the invoice price for the purchaser may need to be adjusted for the purchase returns or purchase allowance. So purchase returns, what are purchase returns? So say we get the product and the seller allows purchasers to return merchandise that is suitable. So say we get the tablets, they come in and 10 of them have cracked screens. We can return those and then that is a purchase return. We have to adjust our inventory when we return items, right? Purchase allowance is along the same amount, right? But it is here's the thing, their amounts granted to purchasers as an incentive to keep goods that are not as ordered. So you may get an allowance, say you ordered 500 tablets, or in this case, we ordered 100 tablets, right? And let's say that the 100 tablets came in and we wanted their tablets that we customized, and they came in and they're supposed to be a certain color on the outside, or they were supposed to be a certain screen size, and they're wrong, right? Let's say we bring that up to the supplier, or we bring that up to who we're purchasing it from. We tell them, hey, we tell Southwest, hey, these screen size were supposed to be 12-inch. You sent us a bunch of 8-inch tablets. And the Southwest can give us a purchase allowance. Say, oh, we're sorry. We'll go ahead and we'll give you a discount. We'll make sure that we don't charge you if you keep the eight, so we don't have to go through shipping costs. We don't have to do all this. We're sorry about our error, or they're not to the quality we thought they were. Okay, we'll give you the purchase allowance. We'll deduct the amount that you owe us, and you don't have to return the product, right? So we'll give you a discount and you get to keep the product. Purchase returns are something like if we're not satisfied with the product, or if it's not anything, there's nothing we can do with it. Most of the time, we'll do a purchase return and just return the item and get our full refund. On June 6th, Smart Touch Learning returns 20 tablets from the June 1st purchase because they were damaged in the shipment. These tablets were valued at a total of $7,000. So we paid $350 per tablet. Now we are going to lower the amount of accounts payable, right? So we debit that account, accounts payable Southwest Electronics Direct, by $7,000 because we're returning the product to the seller, and we're going to be credited with the $7,000 credit because the screens were broken, and then and we can't do anything with them, so we lower. But we also have to lower the amount of merchandise in inventory, right? So we have to go in and we have to say we no longer have $35,000 of merchandise. We have the 28,000. The way we do that is to credit, because merchandise and inventory is an asset. It goes down by credit. We need to credit merchandise and inventory by 7,000 to lower the amount that we owe or how much we have in inventory. This is how we keep track of inventory, by how much we paid for it. And so now we're showing that those 20 tablets are gone. We only have $28,000 worth of inventory. A purchase discount is a discount that the business offered to purchase as an incentive for early payment. So purchase discounts, we talked about this before. We offer if we paid it within that 3 net 30, right? Credit terms are payment terms and purchase or sales as stated on the invoice. When we offer a discount, then we state what kind of discount we're going to offer and how much time are we allowing for them to pay to receive that discount. So most credit terms express the discount time period and the final due date. Example, 3/15 N/30, or 3% discount paid within 15 days, or net pay full amount within 30 days. Means a 3% discount paid within 15 days. Otherwise, the full amount is due within 30 days. So you need to pay us the full amount within 30 days. But if you pay us within 15 days, we'll give you a 3% discount. This way, it helps. We talked about, if you get into a finance class, you'll talk about this, how, and this is one of the reasons we look at cash flows, is because we need to understand how much money is coming in, how much is going out. More money coming in is always better, right? So if you have more money coming in than is going out, that's always going to help your business. You don't want more going out than what's coming in. You can start running low on cash, and cash is what you need to run your day to day business. So under credit terms, 315 net 30 days. If Smart Touch Learning pays on June 15th, which is within the discount period, the company will receive a discount on the balance owed of 28,000. So here's the thing. Because we've lowered the amount because of those defective tablets, the discount is no longer on 35,000. It is going to be calculated based on the 28,000. And so we have to take out the 3% out of the 28,000, not the 35,000, because we no longer owe 35,000. The discount amount would be $840, 28,000 times 3%. The cash payment entry would be accounts payable, Southwest Electronics Direct. So we had accounts payable of 28,000. We paid cash, right? $28,840, right? Or minus $840,000, which is our cash payment of 27,160. And then we have to lower our merchandise inventory by the 840, paid within discount period net return. We're always going to value our merchandise at what we paid for it. So if we ended up getting a discount on our payment, then we need to make sure that we account for that within our inventory and not value our at 28,000. We're going to value our inventory at 27,160. So each tablet is going to be valued at 3% less than what we paid for it, or what we were charged for it at the beginning, because we did receive a discount for it. Cost of goods sold, remember? So we need to account for, and we need to show what we paid for that. And so to show what we paid, we have to include the discount. After posting the entry to the accounts, the merchandising inventory account reflects a balance of exactly what the company paid for its merchandise, 27,160, and the accounts payable balance shows the invoice has been paid in full with no remaining balance. So what happened? Let's look at the accounts that are affected by this. We paid cash. We got a credit to cash because we're lowering the amount. So we had in our account a balance of 6,000 or 60,500. We paid cash of 27,160. We now have a new balance of $33,340 in our cash account. Merchandise and inventory started off at 35,000. We then had to credit at 7,000 because of damaged inventory. That gave us a new balance of 28,000. But then we also got an $840 discount, so now we need to credit at $840 to show that our balance and our inventory is worth 27,160. Accounts payable was $35,000 on June 3rd. Then we debited it 7,000 because we had those returns. So they gave us the debit to our accounts payable, gave us a balance of 28,000 what we owed. Then we paid our 28,000, right? Partially by discount, partially by cash. They gave us a balance of $0. So we don't have to, the accounts payable doesn't get affected by the discount. That's going to change our merchandise inventory and cash. And so we're going to account for the discount through the merchandise inventory and cash accounts. We don't account for it in the accounts payable. We just make sure the accounts payable is fully accounted for and zeroed out, because we no longer have a remaining balance. Assume instead the Smart Touch Learning pays on June 24th after the discount period ends. The cash payment entry would be this. We would not have to do that extra step and discount the inventory. we would just have $28,000 accounts payable debit, which is going to bring our balance to zero, and then cash of $28,000. We did not receive the discount, so we do not have to adjust our merchandise and inventory account. Our merchandise is now still valued at $28,000 because we did not receive that discount. So we actually paid 28,000. That's what we're going to keep it as in our inventory. So transportation costs are part of the selling, right? So this is something we need to understand when we're purchasing or selling things. And we need to understand who's going to pay for the transportation costs. Purchase agreements specify shipping terms to determine when a title of a good transfers to the purchaser or who pays for the freight. So FOB shipping point means the buyer takes ownership title to the goods after the good leaves the seller's place of business. Shipping point. So FOB shipping point, the buyer is the owner of the goods as soon as it leaves the seller's facility, right? So as soon as it starts being transported, that good is now the buyer's good, right? So the buyer is the owner of it while it's in transit, usually pays for the freight. So usually when you do an FOB shipping point, you're paying for the freight and you are owner of that product as soon as it leaves their facility. FOB destination means the buyer takes ownership title of to the goods at the delivery destination point. The seller owner of the goods while in transit usually pays for the freight. So FOB, you need to understand FOB shipping point, the buyer owns it as soon as it leaves the seller's facility. And FOB destination, the buyer does not take ownership of the product until it reaches its destination. Now, which merchandisers are required to pay for shipping cost? Freight in is a transportation cost shipped goods into the purchaser's warehouse, thus it is freight on purchased goods. So if we have freight in, we are paying for shipping of goods that are being transported to us. Freight out is transportation cost that ships goods out of the seller's warehouse and to the customer. Thus, it is freight on goods sold to a customer. So freight out, this is shipping that we are paying to ship to another customer, right? So if we're shipping freight out, that's money that we're paying for shipping to another customers. If it's freight in, we're paying for goods that are being shipped to us. So FOB determines who pays for the freight. FOB shipping point, buyer owns the good, buyer pays for the freight. So if we're doing FOB shipping point, as soon as that we purchase those goods and as soon as those goods leave the facility of the seller, we are now owner of those goods, we pay for the freight. FOB destination, the goods that we don't own the goods till we receive them and the seller pays for the freight. Assume Smart Touch Learning pays a $60 freight charge on June 3rd for purchase at FOB shipping point. And that's going to be because that is part of the purchase, right? The of purchasing the merchandise that will be added to our inventory, right? Merchandise inventory $60, cash $60, credit, so paid a freight bill. So we this is going to be added to the cost of our merchandise, our inventory, because it was part of receiving our inventory. It gets added to our cost. Now, under the FOB shipping point, the seller sometimes prepays the transportation cost as convenience and lists this cost on the invoice. Assume Smart Touch Learning purchased $5,000 of goods with freight charge of $400 on June 20th on account with terms of 3/5 net 30. The terms of shipment are FOB shipping point. So, in this example, merchandise and inventory, we paid $5,000 of goods, right? Purchased $5,000 of goods and we paid the $400, right? So we're going to pay for the $400 of freight. And so we're going to pay for the freight to come in and we're going to pay for the merchandise, but we're going to do an accounts payable. Not going to pay cash right then and there. We're going to put that on an account, right? We're going to put that as a liability. So merchandise and inventory is $5,400. That's a debit. That's an asset. We're adding all of our inventory plus shipping cost, and then we have an accounts payable of 5,400. Now, freight within the discount period. If Smart Touch Learning pays within the discount period, the discount will be computed only on the $5,000 of merchandising cost. Freight cost does not get discounted. The shipper doesn't have anything to do with that discount, right? So shipping costs are going to be shipping costs regardless if you pay early or if you pay on the due date. shipping is always going to be the same. So that is not anything that's going to be discounted. So when you do look this up, we have accounts payable $5,400, cash $5,400 minus the 150. We do get that $150 discount, so we're going to pay 5,250, but it does not include the 150. The 3% does not include the $400. And then we lower merchandise inventory by $150. $5,000 times the 3% gives us 150. Remember, you do not include the $400 shipping charge when you are doing the discount, as freight is or shipping is not included in the discount. So net cost of inventory purchasing, knowing the net cost of inventory allows a business to determine the actual cost of merchandise purchased. Net cost of inventory is calculated as the follows. So we need to know how much did we really pay. So there's always going to be, when there's discounts included, there's returns included, and all these things need to be taken into account. We need to know how much we actually paid for that inventory. This way we know how to account for that inventory, especially in a perpetual system, as we are accounting for each item being sold. And so we need to know how much we need to dedicate to each item as we're selling each item, and how much we need to deduct off of our inventory. So net cost inventory purchased, it equals purchase cost of inventory minus purchase returns and allowances. So we take purchase cost of inventory, what was the seller's retail cost to us? And then we have to take in returns. We have to take into account returns and allowances that were afforded to us. And then we need to minus our discount if we did get the discount. And then we need to add in freight. This will tell us how much we actually paid for our inventory. During the year, Smart Touch Learning buys $697,710 of inventory, returns $150,000 of the goods, and takes an early payment discount of $9,510. The company also pays $36,400 of freight in. So purchases less our returns and allowances minus our discounts gives us, plus our freight in, gives us a total net cost of inventory purchase 574,600. So this is what we can contribute to our inventory, right? So this is what we actually paid for inventory. We were actually our first, if we just went off the invoices that we were first given, we would be off by quite a bit, right? We would have $697,710 worth of inventory if we don't take into account our purchase returns and allowances, our discounts, and if we don't add in our freight, right? So now we can see that we really only paid for that merchandise $574,600. Okay, let's go ahead and move on to section 5.3. We're going to account for the sale of merchandise inventory using a perpetual inventory system. So we're still talking about this is updating inventory as we go, and we are not doing a periodic. We're not talking about periodic. We're not doing a physical count. This is something that's automatically being done as we are selling inventory. As we're selling to customers, we're updating our inventory as product goes out. So how are sales of merchandise inventory recorded in a perpetual inventory system? After a company buys merchandise inventory, the next step is to sell the goods. We shift now to sell inside of Follow Smart Touch Learning through a sequence of selling transactions using the perpetual inventory system. Now we're going to learn how we are going to account for inventory as we start selling the goods and they start flowing out of the business. Cash and credit card sales, the amount of business earns from selling merchandise inventory is called sales revenue. Two entries are required to record a sales transaction in perpetual inventory system. So this is where we're accounting for inventory exact as we are doing the same as we're actually selling the goods, right? So this is how we account for sales and accounting for inventory at the same time. By doing that, we have to have two different transactions. The first entry records sales revenue and cash received. We record our sales as how much we sold it to the customer and how much we received in cash. The second entry records inventory sold, cost of goods sold, and reduction in merchandise inventory. This is why we need to know how much we paid for each item. So as we sell each item, we need to reduce the amount of merchandise inventory for that item that we've sold. So Smart Touch Learning sold 2 tablets for $1,000 cash. That is one transaction. Okay. The tablet has sales price of $500 each, and each tablet costs $350. So we had two. We're going to do two entries for this one transaction. First entry is we're going to account for the sales of those items. We receive cash, $1,000 debit, and then we have sales revenue, which is going to be a credit. Both of those are going up. Cash is going up and sales revenue. We account for that with cash sell. Then we also have to make sure that we're accounting for our cost of goods sold. Cost of goods sold is going to go up $700 as and merchandise inventory is going to go down. Cost of goods sold is going to be a contra asset, or is going to be shown as a deduction, right? It's an expense. So it's an expense. So we're going to expense out what we've sold and reduce our merchandise by that amount. The cost of goods sold is going to go up with a debit, $700. Merchandise inventory is going to go down with a credit of $700. This is record the cost of goods sold. So this way we're merchandise and inventory is going to go down. So now we can account for how much inventory we currently have, and cost of goods sold, our expenses are going up. Retailers often sell merchandise inventory and receive payment in the form of credit card. Credit card sales are recorded in the same manner as sales cash because the payment is usually received via an electronic transfer from the credit card processor within a few days. So we don't put when we receive a credit card payment, usually as a retailer, you don't put those down as accounts receivable. Those are recorded as cash. The retailer also have to pay a fee associated with the credit card sales. So most retailers, this is why some small businesses will give you a discount for cash, is because they're paying a fee for every transaction that they have to do with a credit card. Some sales on account, no discount. Many sales are made on account instead of with cash or a credit card. This is usually done when we're doing business to business, right? So usually if you're doing like in this example, we're selling to a business, right? Pendleton Dentistry, we're selling 5.5 illustrates the invoice for 5 tablets sold from for cash on June 21st, 2026. So in this example, we are here and it says terms net 30 days. We're given a bill. We gave an invoice to our client, but usually it's for business. You usually don't do this if you're doing like customer sales or directly to the consumer. So this is a business to business sale, and here we sold 5 screens for $2,500. Now, Smart Touch Learning sold 5 tablets for $500 each, making a $2,500 sale on account. So this is an accounts receivable, right? On June 21st, the goods cost $1,750. So accounts receivable, we didn't receive cash, so that's going to be our asset, $2,500. Sales revenue, we always account for revenue when it is earned. So they received the goods. Now we've earned $2,500 and we have a sell on account. Now we still have to account for our merchandise. Cost of goods sold was $1,750. Merchandise inventory goes down by $1,750. This is so we have a current account of what our inventory is. So many merchandisers offer customers a discount for early payment. This is also when we are talking about customer business to business. This is usually if you go and you buy from a retailer like Walmart, or you go to Macy's, or you go to Dillard's or some store and you purchase something, there's usually not a sales discount. So this is usually a business to business kind of sales thing. Sales discounts are a reduction in the amount of revenue earned on sales for early payment. So on June 23rd, Smart Touch Learning sold 15 tablets for $500 each on account with terms of 210 net 30. The goods cost $5,250. So we made an accounts receivable West High School, so we sold it to West High School. $7,500. We received sales revenue of $7,500. This is a sale on account less discount, right? So we haven't included the discount yet. We now still need to account for the cost of goods sold. So we have the cost of goods sold and expense, 5,250. Merchandise inventory goes down by $5,250. So how do we account for this discount? So on June 23rd, West High School makes a payment within the discount period, and we get a $150. They get a $150 discount for paying early. So we receive cash, $7,350. Then we have an account called sales discounts. 7,500 times the 2% is a debit of $150. The accounts receivable now is cleared and we have a credit of 7,500. Cash collection within the discount period. So we have two debits, cash and sales discount, And then the other side of that is going to be accounts receivable. We have to make sure our accounts receivable is zeroed out because now they have no balance. If for some reason West High School does not pay within the discount period, the customer will no longer receive the discount and the customer must pay the full $7,500 amount. And we do not have a discount. We only have to do cash and accounts receivable. We receive the 7,500 and the accounts receivable goes down, is then zeroed out by doing a credit of 7,500. So, just when we were purchasing goods, there can be mix-ups, there can be different mistakes that can be had, and we can have sales returns and allowances. So we too, when we're selling the merchandise, we can have things go wrong. Maybe the product gets broken in shipping. Maybe we ship the wrong product. Maybe it's not what the customer asked. So we too can have returns. Customers return products on us, and we too can have allowances for our customers. So we have sales returns and allowances contra account that shows decrease in the seller's receivable from a customer's return of merchandise or from granting the customer allowance from the amount owed to the seller. The return of goods by a customer is called sales returns. So if we messed up and either didn't send the right product or the product was defective, now we have sales returns. That gives the returns the product back to us. Sales returns reduce the future cash collected from the customer or require a refund to be made to the customer. Right? So if we have an accounts receivable, we'll reduce that. If they've already paid us cash, we need to pay back that money to the customer. So when a customer returns the merchandise inventory, the company will need to record a refund of cash to the customer or credit accounts receivable. The company must also return the merchandise to inventory. So if we get, let's just say we have sales returns and allowances, this is where the customer's already paid the cash. So sales returns and allowance, our contra account goes up $2,000. Cash then goes down by 2,000 because we have to return the cash to the customer. That's a refund that we need to give to the customer. Merchandise inventory now needs to go up, right? It's going to go up because now we receive that $800 worth of inventory back to us, and cost of goods sold goes down, right? To record the cost of inventory return, now we have $800. Even though it's defective, we still need to account for it. We still have that $800 of inventory that got returned and needs to be accounted for. Now, a sales allowance occurs when the seller reduces the amount owed to by a customer. The customer does not return merchandise inventory. This is where the customer can be happy enough to keep the merchandise inventory with a discount. When a seller grants a sales allowance, the company issues a credit memo indicating the company will reduce the customer's account receivable or issue a cash refund. So we can it's the same. We're still going to either lower the amount that they owe if they have a receivable, or we're going to give them a refund if they've already paid cash, but they do not have to return the items. So on June 23rd, Smart Touch Learning grants a $100 sales allowance for goods damaged in transit to Pendleton Dentistry. The goods were sold on an account and remain unpaid. A sales allowance is recorded as follows. So here they haven't made the payment yet. So we have sales returns and allowance, $100. Accounts receivable, Pendleton Dentistry. Now we've lowered the accounts receivable by $100, granted sale allowance for damaged goods. So we said, okay, maybe the screen wasn't cracked, or maybe the one of the the screens doesn't have, it's either got some kind of scratch on it or something like that, but it's not a big deal, but we're still going to give them a discount because it's not in perfect condition. After the entry post, the accounts receivable account will show the amount owed by the customer. So now when we give them this allowance, customer now has a balance of $2,400. When the customer Pendleton Dentistry pays the amount owed on June 30th, Smart Touch Learning records the receipt of cash and decreases the accounts receivable for $2,400 as follows. So, cash, accounts receivable, $2,400, cash collected. This is what cancels out that accounts receivable. Notice that we didn't touch inventory because we didn't receive any inventory returned to us. So our inventory stays the same. We just reduce how much the accounts receivable is, and then we receive cash to pay off that accounts receivable. We also need to account for transportation costs when we're doing this. So Smart Touch Learning pay $30 to ship goods to a customer on June 21st. Now, if we're going to be paying for that, it's going to be a delivery expense for us. and cash out. So delivery expenses go up through debit, cash is going to go down through credit. Paid a freight bill. So this is freight out delivery expense to the seller. So we're selling it, we're paying the ship goods to a customer. We're paying that charge, so it's a $30 charge to us. Now let's look at objective 5.4. We're going to adjust and close the accounts of merchandising business. And this is very similar to the adjusting and closing of accounts that we've looked at prior, but now we're going to change it up a little bit with merchandising. What are the adjusting and closing entries for merchandiser? Let's look. Merchandiser adjusts and closes accounts in a similar manner to that of a service entity does, right? What we're really looking at is what are permanent and non-permanent accounts, so temporary accounts. If an optional worksheet is used, the adjusted trial balance is entered, and the worksheet is completed to determine net income or net loss. Merchandisers must also adjust for inventory shrinkage and estimated sales returns. So now we're going to add a couple more accounts that we're going to just be specific to merchandisers. One of those accounts is inventory shrinkage, is loss of inventory occurring from theft, damage, or errors. So with the perpetual system, you will see that even at grocery stores or any kind of retailers, things get stolen, things get broken, things go bad, right? If you're at a grocery store, food can go bad, people can put things in the wrong area, people steal things, right? So those things don't get accounted for when you're doing perpetual systems, right? So you have to go back and count and do a periodic inventory, and then you'll find when things are gone. So that's inventory shrinkage. Businesses take a physical count of inventory at least once a year. So you have to do a physical count even with perpetual because it's not going to account for all the things that got stolen. It's not going to account for the things that went bad and had to be thrown away. It's not going to account for any of that. So that's where we have this account inventory shrinkage to account for those things. So Smart Touch Learning merchandise inventory account shows an unadjusted balance of $31,530, but a physical count comes only to 30,000. So that means we have shrinkage of $1,530. So the adjusted entry merchandise inventory balance before adjustment minus the actual merchandise inventory on hand gives us a difference of 1,530. Now we need to go ahead and account for that. We need to go ahead and account for cost of goods sold, 1,530, and then we have merchandise inventory, adjustment for inventory shrinkage. We have to show that we have this inventory loss and we have to downsize our inventory and we have to adjust that for cost of goods sold. Step 4 is closing process for merchandising company follows. Step 1, make the revenue accounts equal to zero via the income summary account, just like we did with the other service industry, right? These temporary accounts, what are temporary accounts? Revenue, expenses, right? So those close out into summary account. Same thing here. We're going to make the expense account equal to zero via the income summary account. Close that out into the income summary, and then we're going to close out the income summary because that also is a temporary account just to close out our expenses and our revenue. We're going to make the income summary account equal zero via the retained earnings account. This closing entry transfers net income or net loss to retained earnings. So then that's when it gets turned into retained earnings, which is a permanent account. We also need to close out the dividend account equal to zero via the retained earnings account. So we're closing out all these temporary accounts, making them equal to zero. What we do is we take the revenue expense accounts, transfer those into income summary, then take the income summary and transfer that into retained earnings. We don't have to do anything extra with dividends. We just have to close them out directly into retained earnings. Here's an example of adjusted trial balance and closing entries. So here we have our adjusted trial balance. You'll notice that in merchandise and inventory is going to be in blue. That's a new account. And then we also have sales revenue and then returns and allowances, sales cost of goods sold, and delivery expense. These are all special accounts that pertain just to merchandisers. And then you can see our temporary accounts are going to be those that are within our mostly on our income statement. Dividends is going to be your statement of retained earnings, right? We have the revenues, expenses, and dividends need to be closed out into our permanent account. And here's an example and a picture showing you how we're closing those accounts out. So sales revenue is a has a usual credit balance. We're going to debit it to zero it out. Income summary and into income summary. And then expenses usually have a regular debit account. So we're going to credit all of our expense accounts and debit income summary, transferring those amounts into income summary. Now, when we put those accounts into income summary, you can see the income summary, we balance it out, and we can see that we have a income summary of closing out. We have an income summary balance of 999,420, which is going to be that's going to be a net loss, isn't it? We had oh no, that's net income. The net income of 99,400. We have a credit balance. So that's revenue. We have revenues over expenses. So we are putting that revenue, we're closing out income summary and crediting our retained earnings to show net income of 99,420. And then we had dividends of 10,000, which we are going to close out and transfer directly to retained earnings. So that net income is going to raise retained earnings by that 99,000, but then dividends is going to lower retained earnings by the 10,000. Let's look at objective 5.5 and prepare a merchandiser's financial statements. Very similar to what we've seen before, just a little bit different than what we've seen with revenues of a service industry. The financial statements that you have learned the service net sales revenue is the first item listed on an income statement. It is calculated as sales revenue less sales returns and allowances and sales discounts. Net sales revenue is the amount a company has earned on sales after sales returns and allowances and sales discounts have been taken out. So this is where we take our net sales revenue. So we take what we have sold. First thing we take out is the sales returns and allowances, right? So everything that has been returned to us, all the allowances we have granted our customers for either damaged merchandise, merchandise that's not correct, invalid orders, things like that. And then on top of that, we take out sales discounts. And that gives us our net sales revenue. So we have sales revenue, less sales returns and allowances, sales discounts, and then we have net sales revenue. So we finally get down to what is actually been sold. And then from that, we have two formats. The first format, an income statement, a single step income statement, groups all revenues together and then lists and deducts all expenses together without calculating any subtotals. That's not what you're usually going to see. What you're going to see is a multi-step income statement. This contains subtotals to highlight significant relationships. In addition to net income, it reports gross profit and operating income. And that is what you're going to see on almost every statement that you come across is going to be a multi-step income statement. First thing we're going to calculate is your net sales revenue. Then we're going to get your cost of goods sold and then your expenses. Now, most of the time, when you get your cost of goods sold, you'll get your gross income and then you'll get the rest of your expenses. So, we had another example prior where you can see your net sales revenue. This is a single step income. So, you're not going to have this cost of goods sold separated. When you go to a multi step income, now you're going to see multi step income is different than a single step income because it has lists several important subtotals. These totals include gross profit, operating income, and other income, and expenses, income before income tax expense, and net income. So gross profit, we get our cost of goods sold, and then we have subtotaling of our operating expenses and subtotaling of administrative expenses. And then we get total operating expenses, 250,000. That gives us our operating income. And then other income and expenses, interest expense. Then we get our net income, our income before taxes and expense, or income before income tax expense. And then you have income tax expense, and then you have your net income. So this is important because it tells us where we can start looking at where most of our expenses are coming from. And we can compare. We can compare if taxes have gone up or if taxes have gone down or how much are we paying in interest and things like that. So these are all things that we need to look at. And then some expenses, operating expenses, cost of goods sold, all those are things that you can deduct on taxes. So once you take a tax class, you'll start to realize how important and deductions are. And so a lot of these expenses you can deduct, and so it's better to separate them out. And on top of that, some things you can't deduct. So there's been a lot of changes in the law for interest expense with big corporations. So it's important that they track how much is interest. Operating expenses are reported in two categories. Selling expenses are related to marketing and selling the company's goods and services, and administrative expenses include expenses not related to marketing the company's goods and services. So selling expenses, anything like advertising, sales workers in the sales group, administrative expenses, you're looking at anything on the operations side, HR, accounting, all these other things that help support the group. Even some higher supervision positions are going to be administrative expenses. Gross profit minus operating expenses equals operating income. So we have to get gross profit, we're going to subtract cost of goods sold. Then we take away operating expenses, and now we have operating income. Other income and expenses report revenues or expenses that are outside the normal day to day operations of a business, such as a gain or loss and sell plant asset or interest expense. These are things that company may have investments other places where they've earned interest income. So that's where that will go. Say that there's an asset such as equipment or vehicle that the company no longer uses or is replacing and they sell that vehicle for a loss or a gain, that's where you're going to see that income or expense. Income tax expense reports the federal and state income taxes that are incurred by the corporation. So you will see that as well on the income statement, but that will be included at the bottom because that tax is going to be determines that tax is going to be your amount of all your other income. So other income and expenses are going to determine how much you're going to be taxed on. Now, the balance sheet will also look the same as for a service business, except merchandisers have an additional current asset account, merchandise inventory. So that's the new thing that we're going to be adding to our balance sheet. Service businesses do not have merchandise inventory. They have supplies, but they do not have an inventory in their balance sheet. Now, let's learn 5.6 use a gross profit percentage to evaluate business performance. So, how are we going to do that? So the first thing we're going to do is the gross profit percentage measures the profitability of each sales dollar above the cost of goods sold. So how much are we making over what we pay for an item? So hitting gross profit percentage is desired, a high gross profit percentage is desired. So you want to buy low, sell high, right? Anything that you resell, the lower price you can get for it and the higher you can sell it for, the more profit that you gain. The more businesses, they want higher gross profit percentage. That gives them a lot of leeway to have other expenses and not lose profit, right? There's a lot of overhead that goes with merchandising, right? You have advertising costs, you have sales costs, you have operating costs, you have to run department, you have storage costs, right? Operating costs are still considered operating costs like renting the building, storing the merchandise. All of that is extra cost that the merchandiser is going to have to incur. And so the more gross profit that a company can have, the better they will do overall. So, gross profit over net sales revenue. So, let's look at this. Pepsi Corporation reported the following: net revenue for the year ended December 2021 was 79,474 million. Cost of sales 37,075 million. For the decade ended in 2020, 70,372 million, and the cost of sales was 31,797 million. So let's look at the gross profit percentage year in 2021. If you take our gross profit percentage, you take the 79 over the 37, or 79 minus the 37, cost of sales. So we take our revenue and we take our to get our gross profit, we take our revenue minus our cost of goods sold, divide that by our revenue. That gives us 53.3%. In 2020, we took the amounts from that year and we had a higher percentage. We were actually making 54% over percent for a gross profit percentage. So they were actually doing better. We were making more money percentage wise, right? Now, the dollar amounts may be higher for 2021 when you're taking in just net revenues, see net revenues, but the cost of sales were higher as well. So percentage wise, they were making more money, our gross profit percentage, in 2020 than in 2021. So you can kind of see this. And the reason this is valuable information, you can see how a company, how they're doing when they're negotiating cost of goods sold and what area they can improve on. Account for purchase and sale of merchandise inventory use a periodic inventory system. So let's look at Appendix 5A. This is where we're going to look at the periodic system. So we've already talked about the perpetual system that monitors the merchandise inventory as we make sales. Excuse me. In this section, we're going to start talking about and we're going to look at the periodic inventory system. This is where we physically count, which we do in the perpetual system, but usually only once a year. Here, this is what's going to be done either monthly, quarterly, or yearly, but this is how we monitor how much we have on hand. It has to be hand counted and everything, or it has to be done by hand and is going to be tallied, and this is where you don't have loss. You don't do that. You don't have to. We'll see that. We'll watch in this next couple of slides. So, how are merchandise inventory transactions recorded in a periodic inventory system? Perpetual inventory systems are too expensive for smaller businesses. There's a lot of businesses that can't afford to have that kind of system, and it's very costly, and it takes a lot of time and money to run those kinds of systems. And when you're, it takes time. If you've ever worked at a retail place, a lot of the times you're just taking in inventory and clocking it in, right? And making sure everything's, you're scanning it in, getting everything up, the system up and ready. So then when you start making sales, everything is correct. The periodic, so for companies that can't do this, small companies, they have the periodic inventory system. It requires physical counts of inventory to determine quantities on hand. And a lot of places, small businesses will do this on a monthly basis. It- First, because it is expensive. Second, because they don't have a lot of inventory to count. So it is possible to do this with a small amount of workers. Merchandise inventory is updated at the end of the period during the closing process. So, referring back to Exhibit 5.3, Smart Touch Learning purchased $35,000 of inventory with terms 3, 15, and 30. Under the periodic inventory system, Smart Touch Learning will record the purchase of inventory using an account called purchases. So, we're not using inventory. We're not going to be using the merchandise and inventory account. We're going to be using purchases. So, when they make the purchase of the inventory, you're going to debit purchases. That's where all your inventory is going to be going. And then you have accounts payable, since this is going to be done on account. And so you got your debit, your credit, accounts payable, purchase inventory on account. Prior to payment on June 6th, Smart Touch Learning returned 20 tablets to the vendor costing $7,000. And now we do reduce accounts payable by debiting the accounts payable by 7,000 because we returned that inventory, the credit for it. And purchase returns and allowances is still an account that we use with the periodic inventory system. So purchase returns and allowances, $7,000 credit, returned inventory to seller. So you see purchases stays at 35,000, purchase returns and allowances. That's what's a contra account that's going to be used to give us our totals with purchases. On June 15th, Smart Touch Learning makes payment for the merchandise less $7,000 return within the discount period. Accounts payable $28,000. Cash was 28,000 minus 840. They did do the discount period, so they only paid 27,160. And then purchase discounts 28,000 times 0.03 40. Paid within the discount period. So accounts payable, you see the 7,000 that was taken, and then or 35,000, then we deducted 7,000, got a $28,000 balance, and then we paid the 28,000 through cash and purchase discounts. So under periodic inventory system, freight in is debited to a separate freight in account, an adjunct expense account, as opposed to debiting the merchandise inventory account. So Smart Touch Learning pays $60 freight charge on June 3rd as follows. So freight in is a different account. Instead of adding it to the merchandise into the inventory, it is done as a separate expense. So freight in is going to be an expense account, debit, or an adjunct expense account, and that's going to be debited. Cash will be credited, and then are paid a freight bill. Under the periodic inventory system, the net cost of merchandise inventory purchased must be calculated. So the balance of the purchases is a gross that does not include subtractions for purchase returns and allowances and purchase discounts or additions for freight in. So the balance of purchases is a gross. So purchases is just going to be keep on as a gross account. We don't manipulate it until we have to calculate it. So we want to get the net cost of inventories calculated as follows. Start off with purchases, then we reduce them by repurchase returns and allowances. Then we will also reduce it again through purchase discounts. This equals our net purchases, but then we have to include freight in. We go back and include freight in, and that gives us net cost of inventory purchased. Very similar to periodic, but unlike periodic, we're not doing this within the inventory account itself. This is all done outside, and we keep purchases a separate account. And then when we want to calculate the net cost of inventory purchased, we have to do all these calculations separately. So that is one thing that happens with the periodic inventory system. There's no running record of inventories maintained. So at any given time, you do not know what how much inventory is actually within the company, right? This is something that has to, if you want to find that out, you have to start doing inventory. You have to manually or physically start counting and adding up all the inventory. There is no need to record an entry to merchandise inventory and cost of goods sold. The reason for that is that you have your sales, but you're not doing a running it. So because you do not have an updated inventory at any time, you only have purchases. You do not have to do two entries every time. There's no need to record the merchandise inventory. Accounting for sales discount and sales returns and allowances is the same as under the perpetual inventory system. It's just that it's not done within the inventory account during, because we're keeping a running balance. That's done within the inventory account with the perpetual system. Okay, on June 21st, Smart Touch Learning sold 10 tablets for a total of 5,000 on account with the terms of 210 net 30. So we have accounts receivable, Lions Company, sales revenue, and then sales on less discount. So this was already paid. Our accounts receivable, 4,900, and then 2 net 10. So when this is already conducted, the 2% has already been calculated within this account or this transaction, this journal entry. The periodic inventory system requires an additional calculation in the cost of goods sold. At the end of each period, the company combines a number. So let's go back to this. 10 tablets for total. Here, we've already accounts receivable and then sales revenue. When sales on account less discount, when you go ahead and make that journal entry, you are already making the discount in there as well. Come back to preparing financial statements, periodic inventory system. The periodic inventory system requires an additional calculation of cost of goods sold. At the end of each period, the company combines a number of accounts to compute the cost of goods sold for the period. And this calculation is shown on the income statement. So once again, instead of having, we do the cost of goods sold a lot easier with the perpetual system as you're keeping a running balance and you're doing these transactions as they're happening. This is, like I said, it's not done within the inventory account, so it has to be done outside. Cost of goods sold is calculated as follows for Smart Touch Learning. So we have our beginning merchandise inventory, 0, purchases, less purchase returns and accounts, purchase discounts, net purchases, plus freight in, net cost of inventory purchased, cost of good available for sale, ending inventory, and then cost of goods sold. Okay, so this, you have to make sure that you're doing this. Includes $1,600 estimate returns inventory. So here you have purchase returns and allowances as well here. So this, instead of having it and then having a certain amount and then going back and having to adjust for what's physically there and account for losses and things like that, we don't have to make that adjustment because we're only taking in purchases and then we're given a physical count. And then when we take inventory, then we just deduct it as what less the ending inventory, and then tells us what we had go out and cost. No adjustment is required for inventory shrinkage. Temporary accounts are closed via the income summary. Purchase returns and allowances, purchase discount, purchases, and freight in. These are all temporary accounts, and they are closed very similar to the periodics, the Perpetual system when closing out your system. Adjusted trial balance and closing entries. So we have our adjusted trial balance, merchandise and inventory beginning, and then you have your purchases, purchase returns and allowances, purchase discounts, and freight in. And these are all things that have been added for being a merchandising company. Income summary. So, how are we going to close? We take in our revenues and close them out into our income summary. We take our expenses and close them out into our income summary. Then that income summary is closed out into our retained earnings, and then our dividends are closed out to our retained earnings. That will give us our ending balance, what our current retained earnings are. The four-step closing process under periodic inventory system. Step one, use the periodic inventory system, sales revenue and sales discount, forfeited or closed with a debit via the income summary. All their temporary accounts with credit balances are also closed. The ending merchandising inventory and estimated returns inventory are recorded as debits. The step two, expense accounts and other temporary accounts with debit balances are closed via the income summary. So all those are going to be expense accounts. These inventory and income accounts are going to be closed in the income summary, and inventory and estimated returns inventory. Expense accounts are closed into the income summary. The beginning merchandise inventory purchases and freight are also closed via the income summary account. So all of the expenses close into the income summary, merchandise inventory, purchases, and all those accounts are then closed into the merchandise inventory account so we can have our closing balance. And in step 3 and 4, these steps, closing the income summary and dividend accounts, are the same under both the perpetual and periodic methods. So account for sale of the merchandise and inventory using the net method. So let's look at the net method. Many merchandisers offer customers a discount for early payment. Sales discounts are a reduction in the amount of revenue earned on the sales for early payment. The new revenue recognition standards require sales to be recorded at the net amount or the amount of the sales less any sales discount. So using the net method we saw earlier, when we go to make the journal entries, we enter it in as any at the sales amount. On June 23rd, Smart Touch Learning sold 15 tablets for $500 each on account with terms 210 net 30. The cost of goods was $5,250. So that doesn't change. But here, when we enter in the June 23rd accounts receivable and the sales revenue, using the net method, we're already going to deduct the discount, right? So we're going to go ahead and assume that they're going to take that discount. And when we enter it in, we're not going to enter in 7,500 as account receivable. We're going to enter in 7,350, taking the 7,500 minus the 2% of a discount. When customers make payments within the discount period, Smart Touch Learning will record the receipt of the cash and decrease the accounts receivable for $7,350 as follows. So here, if they make the payment within the sales discount window, we're only having to make one transaction, and it's only one debit, one credit. We're debiting cash that we received and crediting the accounts receivable. We don't have to change anything because we've already made it known that we were expecting them to go ahead and pay it within the discount window. So there's no other adjustments need to be made. Now, if the customer does not pay within the discount period, the customer no longer received the $150 discount. The customer must pay the full $7,500 amount. Smart Touch Learning would record this discount loss as follow. So instead of recording it as expecting them to pay the $7,500 and then adjusting for if they pay within the pay period, this way we are adjusting it only if they pay after the discount period. And in this situation, they did pay after the discount period. So we have cash received 7,500, accounts receivable now we did have that at 7,350, and then sales discount forfeited is a different account that is going to be another revenue account, and that's going to be $150. Cash collections outside the discount period. So in this situation, we're making it known that we're expecting them. when you're doing the net method, businesses are expecting the customer to pay within the discount period, and only do we have to make adjustments if the payments are made outside the discount period. This concludes chapter 5. If you have any questions, please let me know and we can discuss them further.